Good morning to all. Today we are going to discuss one case law from the Income Tax Act and Section 69 of the Income Tax Act. That is Section 69C. Section 69C deals with unexplained expenditure. Section 69C, where in any financial year an assessee has incurred any expenditure and he offers no explanation about the source of such expenditure or part thereof, or the explanation, if any, offered by him is not in the opinion of the income tax officer satisfactory, the amount covered by such expenditure or part thereof, as the case may be, deemed to be the income of the assessee for such financial year, provided that notwithstanding anything contained in any other provision in this act, such unexplained expenditure which is deemed to be the income of the assessee shall not be allowed as deduction under the head of income. This is section 69, subsection C. Just a minute, 1 minute. Please behold. Yes. Now, coming to the case law. What is the case law now? Just come down. This is the case relating to Bharati International Limited versus Deputy Commissioner of Income Tax. This observation given is that there cannot be sale without purchase. What happened in this case is that the assessee has purchased, it's a trading, it's a company involved in trading. They purchased certain products and they sold to other two companies. What happened is the assessing officer sent a draft assessment order that the purchases are bogus, therefore it is not taken into account and you are liable to pay income tax on that. This assessee has agreed by this order, has went to file an appeal before the dispute resolution panel, that is DRP. The DRP has said that without purchases there cannot be a sales. So disallowing the expenses of purchase is not allowable and directed the income tax department, that is assessing officer, to reconsider his order. Even though the order was passed with this observation, assessing officer finally not included that expenditure or not taken into account that expenditure and considered it as a bogus. Finally, the assessee has went on appeal against the order of the assessing officer. And assessing this income tax appellate tribunal held that upheld the order passed by the DRP, that is dispute resolution panel, stating that when there is a purchase, there's the sales. When if there is no purchase, then there is no sales. Then how you are disallowing these purchases, stating that it's a bogus. You are taking into consideration the sales. That is, whatever he purchased, he has sold. But you are taking the consideration of that sales, but you are not considering the purchase. So if there is no purchase, then how is the sales will take place? And your order is not allowed. So this is the order passed by this income tax appellate tribunal. Let us see what the case is. The appellant or assessee has challenged the disallowance of rupees 15 crores 17 lakhs 87,755 towards bogus purchases as per the draft assessment order. The assessing officer proposed disallowance on account of bogus purchase of denim fabric from Sun Gold Trade Private Limited amounting to rupees 15 crores 17 lakhs 87,755 rupees, which was intent sold to two parties, namely Sivoham Trading Private Limited and Shakumbari Trade Link Private Limited. The assessing officer held the purchases made from STPL, that is Sun Gold Trade Private Limited, as bogus purchases and proposed additions under section 69C in the draft assessing order. The assessee submitted before the dispute resolution panel that the assessee is also engaged in the business of trading fabric. The purchase from STPL represent trading activity by the assessee, where the goods purchased have been sold to two parties without any modification. The trading transaction have resulted in profit for the assessee company. The sale of goods to these two parties could not be carried out without a corresponding purchase, which is assigned as bogus purchase by the assessing officer. The DRP noted that there cannot be any sale without purchases in any business transaction, as the accounting is complete only by taking into account both sides of transactions, that is purchase and sales. The sale and purchase transaction are thus required to be simultaneously considered. The assessing officer was accordingly directed to make verification in the light of the observations. This is the observation given by dispute resolution panel. The DRP assessing officer in the final assessment order, however, continued to treat the purchase of fabric from STPL as bogus and refused the claim made under section 37 without bringing any fresh facts on record. The assessee contended that in trading activity, the assessee ultimately earned a profit of rupees 10,36,945. The details of purchases and sales are given in the assessment order itself. All the purchases and sales are duly recorded in the books of account. The assessing officer has duly accepted the sales, but refused to accept the purchases and consequently failed to appreciate that no sales can be carried out without corresponding purchases. The action of the assessing officer has resulted in double taxation, one by way of sales recorded and another by way of disallowance of corresponding purchases of the same goods sold. Okay, he made the purchase and he sold that products to some other companies, but assessing officer is taking into account that sales, but is not taking the purchases, is treating it as a bogus. How it can be possible? This is the argument posed by this assessee before the Income Tax Appellate Tribunal. The tribunal held that the assessing officer was not justified in making additions, as the DRP has held that there cannot be sale without a purchase. When the sale figure is taken into account by the assessing officer for computing the income of the assessee, the purchase figure is required to be considered. The bench observed that the exclusion of purchases from trading results is not permissible without corresponding exclusion of sales in such trading activity for arriving at a fair and balanced view. The action of assessing officer patently offends the rudimentary principle of accounting. The Income Tax Appellate Tribunal has deleted the addition made by the assessing officer, as there cannot be a sale without a purchase. This is the order passed by the Income Tax Appellate Tribunal. So, when we considering the sale, that is what was purchased by the assessee, the same product was sold to other two parties. That is clearly recorded. But the assessing officer has said that the purchase is bogus. Then why you are taking into consideration of that sales? If the purchase is bogus, then how the sales will be a real? This is the question. So the assessing, the Income Tax Appellate Tribunal and DRP has clearly stated that these are all genuine transactions and it should be allowed. Okay. So this is for today. If any doubt you are having, you can ask to me now.
No, sir, you have explained so well.
Thank you. Bye. Yeah.
No, sir.
Thank you.
Sir, I have a doubt.
Yes.
Yes, sir. Before this Income Tax Appellate Tribunal, there is a line: the action of the assessing officer patently offends the line. That line, sir, can you
Yes,
explain that?
rudimentary of principle of accounting.
Yes, sir.
Yes. So what you have to see is you are taking the sales. If you are saying that sales is correct, then what is sold? He made the purchase of the goods. The same was sold. If purchase is bogus, the sales is also to be bogus. Then you are taking the sales into account, but not the corresponding purchase into account. You are saying that that is bogus. You understand?
Yes, sir. Yes, sir.
So both has to be considered a balanced view. You are not arrived at a balanced view. That's what they have said. It is a offends the rudimentary principles of accounting. Okay.
Thank you so much, sir.
Thank you. Who is taking next? Anybody?
Yes, sir. It's me, Devi.
Okay. Stop sharing the screen.
Thank you, Prerna. Good morning, everyone. Good morning, sir. Good morning, ma'am. So today I'm going to take a session of responsibility of professionals. While the Companies Act 2013 provides a new and significant area of practice for the company secretary, it's cast immense responsibility on the company secretaries. Company secretaries must take care while certifying the annual return. Any failure or lapse on the part of PCS may attract penalty both under the Companies Act 2013 as well as under the Company Secretaries Act 1980 for the professional or other misconducts. Now, guidelines for issuing secretarial audit report, signing and certification of annual reports are in terms of power vested by Clause 1 of Part 2 of the second schedule to the Company Secretaries Act 1980, that is 56 of 1980, as amended by the Company Secretaries Amendment Act 2006. The Council of the Institute of Company Secretaries of India, in suppression of the guidelines issued for issuing and compliance certificate and signing of annual return on 27th November 2007, hereby issues the following guidelines. The guidelines are annual return. A member of the institute holding a valid certificate of practice shall be entitled, point number 1, to certify annual return pursuant to section 92 and subsection 2 of the Companies Act 2013, that is Act number 18 of 2013, for more than 80 companies for each of the financial year under consideration. That is point number 2, to sign annual return pursuant to section 92, subsection 1 of the Companies Act 2013, that is Act number 18 of 2013, that for any number of companies for each of the financial years under consideration. These guidelines shall come into effect for signing and certification of annual return for financial year 2014 and 15 onwards. Now, penalty on company secretaries for false statement and wrong certification. The company secretaries must take care while certifying the annual return. That is, any failure or lapse on the part of the PCS may attract penalty under Companies Act 2013 and Company Secretaries Act 1980. As stated above, the point number 1, Companies Act 2013. Point number 1, as per subsection 6 of section 92 of the Act, if a company secretary in practice certifies the annual return otherwise than in conformity with the requirements of this section or the rules made thereunder, he shall be punishable with the fine, which shall not be less than 50,000 rupees, but which may extend up to 5 lakh rupees. Point number 2, further company secretary in practice may also attract the provisions of section 447, section 448 and section 449 of the Companies Act 2013. Section 447 deals with the punishment for the fraud, which provides that any person who is found to be guilty of fraud shall be punishable with the imprisonment for a term which shall not be less than the 6 months, but which may extend to 10 years and shall also be liable to fine, which shall not be less than the amount involved in the fraud, but which may extend to the 3 times the amount involved in the fraud. In case the fraud in question involves public interest, the terms of imprisonment shall not be less than the 3 years. Now, section 448 provides that if in any return, report, certificate, financial statements, prospectus, statement, or other documents required by the purposes of any of the provisions of this Act or the rules made thereunder, any person makes a statement that is A, which is false in any material particulars, knowing it to be the false, or B, which omits any material fact knowing to be a material, he shall be liable under section 447 of the Act. In view of this, professional will be penalized under section 448 in case he makes the statement which is false in any material particular, knowing it to be a false, or which omits any material facts, knowing it to be a material. Now, authority to initiate action against professionals. That is MCA writes its circular number 10 by 2014 dated 7/5/2014 has clarified the regional directors or ROC would initiate action under section 448 and 449 of the Act in the case of the submitting false or misleading or incorrect information. That is, now Company Secretary Act 1980 states that PCS may be liable for various actions by disciplinary committee of the ICSI as mentioned under section 21B, subsection 3 of Company Secretary Act 1980. In case the committee is of the opinion that a member is guilty of a professional or other misconduct as mentioned in clause 5, 6, 7, 8, and 9 of part 1 of the second schedule to this act. Cases under section 48 and 448 and 449 would also would be referred to the concerned institute for conducting disciplinary proceedings against the irritant member, as well as the MCA will debar the concerned professional from filing any documents on the MCA portal in future. Now, see company secretary regulations. The company secretary in practice shall be liable for professional or others misconduct mentioned in first and second schedule or both the schedules to the Company Secretaries Act 1980, and where held guilty be liable for the following actions that are: point number 1, where found guilty of a professional or other misconduct mentioned in the first schedule, that is A, reprimand. Number B, removal of the name from the register of the members up to a period of 3 months, or point number C, fines which may extend to 1 lakh rupee. And point number 2 states that where found guilty of professional or other misconduct mentioned in second schedule, that is reprimand, B, removal of the name from the register of members permanently or such period as may be thought fit by the disciplinary committee. And point number 3, which may extend fine which may extend to 5 lakh rupees. I hope so. I have made myself very clear. Thank you, everyone. Thank you, sir.
Thank you, Devesh.
Thank you, Devesh. Thank you, sir. Thank you, ma'am.
Thank you, Devesh. Thank you, sir.
Thank you, sir. Thank you, Devesh.
Thank you.
Thank you, Devesh.